Well, welcome to our High Rock monthly video. I'm Scott Tomlinson, and with me is Paul Tepsich, the founder of High Rock, and Bianca Tomlinson, our certified financial planning professional, is also on the call. Well, as we stated last month, our theme from there remains intact. We're at the tail end of what we think is the economic expansion cycle that began in 2009. The U.S. Federal Reserve has been raising interest rates. They'll probably do it again this week, and then they'll review. But U.S. unemployment has likely bottomed, and jobless claims, which tend to lead unemployment in the United States, have actually started to rise. So we're going to watch that development very closely. In Canada, oil prices have been falling, and that does impact, historically has impacted GDP growth in Canada. So oil prices basically fell off a cliff over the last couple of months. They've rebounded ever so slightly at the beginning of December, but we're keeping an eye on the impact there. But that will likely curtail the Bank of Canada from raising rates anytime in the near future. Again, we'll watch those developments too. Well, given that we're at the end of our cycle, and it's our end of cycle theme, our investing models are set up to be defensive at this time. So we're more concerned with protecting our capital through these turbulent times so that we can begin the next cycle positioned to get back to above target growth. The balanced portfolios with less tactical model exposure were flat to slightly higher in November. Portfolios with greater tactical model exposure were lower by anywhere up to 1%. Paul, do you want to talk a little bit about fixed income?
Yeah, sure, Scott. We really didn't do any trades in the fixed income portfolios through the month of November, but just a quick recap of the various securities that are in there. Government bonds actually started performing better and providing that sort of flight to safety or quality during the equity volatility that we saw. So that was somewhat helpful and added to some value. Credit spreads in investment grade are definitely wider. High yield bonds spreads were wider, prices lower as well. Some of that related to the energy space, as we saw in a previous chart, which happened to Canadian oil due to transportation issues, although that hopefully is turning around a little bit right now with measures out of the province of Alberta. And then preferred shares, because credit spreads widened out, preferred shares were also hit pretty hard through October and November. We didn't really add any preferreds during the month of November. We did buy a bit of a downdraft in October. They're starting to look pretty cheap. I know some folks are starting to look at buying those, but we will likely wait on those. So that's it for fixed income, Scott.
And just as a reminder, preferred shares are about a 5 to 6% weight of the total portfolio in our standard 60-40 kind of model.
And then just on that, they have roughly a 5-6% yield on them right now.
Yeah, and that's good income generation in a nice tax-friendly dividend manner. Let's talk about the global equity model, because we have been carrying significantly more than our target amount of cash equivalents, which is in the form of a money market fund earning somewhere in the vicinity of 1.7% annually. But with all the volatility that we've seen in equity markets over the course of this year, and certainly through October and November, it's been good to be as light as we have been in the global equity model. We do think there's some potential downside, even to get back to the bull trend line from 2009. We could see anywhere up to a 14% move lower. So we're going to remain cautious and keep our high weighting in cash, but we will certainly start to put that money to work as we get closer to that bull trend line, and if it perhaps breaks through there. Paul, do you want to talk a little bit about the tactical model?
Sure. The Canadian tactical model is had a bit of a rough go, as Canadian equities have in that chart there, and some of it related to energy. We remain under fully invested in the tactical model, but nonetheless, the positions that we have had, some of them have hurt. One in particular has done pretty well, and we haven't monetized it yet, but it will monetize on its own in 30 days. It's a high yield bond that's being called from us. The rest of the positions in there, we maintain roughly 50-50 weight between high yield bonds, which these particular high yield bonds we consider equity risk, so we're more conservative in our estimate of the risk, and the other 50% are in equities. And we still see in a couple of positions, although they've been hit down reasonably hard, we still see value, and that's part of the reason why we maintain these investments, because we think at some point value will surface. So, not a great month, and quite frankly, not a great year in many of these Canadian tactical positions, both specifically the equity side, Scott. We should also mention, Scott, back in fixed income, that our average client is now probably sitting around 30% plus in cash. So a very defensive posture overall.
Exactly. Okay. Thank you, Paul. Well, that's it. If you would like to discuss your portfolio and your strategy in greater detail, please feel free to get in touch with us. We would be more than happy to talk very specifically about your respective portfolio. But at this point, we'd like to take a moment to wish you all the best for the holidays and wish you a very happy, healthy, and prosperous new year.